Well, hello and welcome to the LCN Legal webinar on legal implementation of transfer pricing compliance and focusing on limited risk distributors. My name is Paul Sutton and I'm one of the co-founders of LCN Legal, and we specialize in intercompany agreements and related corporate structuring for multinational groups, working alongside tax and transfer pricing professionals both in-house and in private practice, and also working alongside in-house legal counsel. So we're focusing today on limited risk distributors, and the reason for choosing this subject is that, number one, they're a very common structure used by a lot of groups, but number two, they're often implemented very poorly in our experience from a legal perspective. So we're trying to share some practical experiences in terms of how to get this right. And what we're going to cover are what are limited risk distributors, so just recapping on that. We'll talk about what does legal implementation of transfer pricing actually mean. We'll look at a timeline in practice just to see how the legal implementation fits in with the tax and transfer pricing implementation. And then we'll talk about creating templates, intercompany agreements, and specifically approaches to ICA pricing clauses for limited risk distributors. And finally, we'll wrap up with some action points. So what are limited risk distributors? Well, we've included in this slide a very simplified extract from a typical group using this kind of structure. And you can see in this example, there's the parent company, which holds most of the IP, which undertakes some manufacturing activities and some R&D activities. And it has various regional distribution networks. So we've just shown the European network in this example. So there's an entity within Europe which acts as the entrepreneur and which supplies products to a series of limited risk distributors in the local jurisdictions and the local markets. And also they have a network of limited risk service providers which provide related services as reseller. And in terms of those distributors and resellers of services, they act as principal in terms of making the sales or the supplies to their local customers, and therefore, in the ordinary course of things, from a legal perspective, they would bear a certain amount of risk. So if we look at, well, what are the key features of limited risk as opposed to full risk distributors, we've included on this slide some of the common statements that you'd see in master files and local files. So often it will say, well, these distributors carry limited market risk, which is really a combination of a number of different factors here. Limited inventory risk. So sometimes distributors will carry no stock at all on the basis that the actual delivery, the fulfillment of orders is made directly from the entrepreneur or maybe a manufacturer. Or if they do hold stock, then they are intended to be de-risked from the risk of that stock becoming obsolete or being unsellable for some reason. Often the master files and local files will say that these distributors carry limited product liability risk, and we'll come on to what that means later. And finally, and really fundamentally, often there's a statement saying that distributors have a guaranteed return. So really, those are the key elements, if you like, of a limited risk distributor. Sometimes there may be additional elements such as limited credit risk. So this is about the risk of non-payment by customers and being separated or ring-fenced from foreign exchange type risks. And one of the key things with any transfer pricing structure is that you need to look at the interests of each individual legal entity which is being asked to participate in that structure. So if, for example, if you imagine yourself as a director of a limited risk distributor and you're being presented with this business proposition that involves you carrying certain overheads, which may be fixed to a large extent, you're being offered the possibility of getting a pretty low return. So often you're talking about a margin of like 2% or 3% as compared to a full risk distributor, which may achieve 10%, 20%, or even 50%, depending on the relevant markets. the quid pro quo of that is probably going to be, well, that return needs to be guaranteed. And that's why it is described as such in a number of transfer pricing documentation. So that's an overview about what limited risk distributors are. If we move on and say, okay, in that context, what does the legal implementation of transfer pricing actually mean? And there can be a lot of misconceptions around this. What we've done here is we've extracted 2 passages from the OECD's transfer pricing guidelines, so the 2017 edition. The first quote I won't read out, but you'll see it. It just confirms what pretty much everyone already knows, which is that the evidence as to the contractual assumption of risk, in other words, intercompany agreements, is a very important part of a tax administration's transfer pricing analysis of risk. So clearly it's not the final word on this, but it is part of the analysis and part of the steps that corporates and tax administrations need to go through in order to understand the transfer pricing analysis of any given arrangement. And of course, from a documentation perspective, the intercompany agreements need to be listed out, so that the material ones need to be listed out in the master file, and actual copies of intercompany agreements need to be attached to the local files. The second quote at the bottom left there, I will read out because it is absolutely fundamental here. And the quote is, the purported assumption of risk by associated enterprises when risk outcomes are certain is by definition not an assumption of risk, since there is no longer any risk. And really this is a statement of the obvious again. So just as you can't bet on a horse race after the winner has been announced, so you can't contractually allocate risk after the event. And this has a number of really important implications as regards legal implementation of transfer pricing. And we could spend a whole webinar or a whole day just talking about this, but we've summarized it on the right-hand side. So what it means is, number one, the contractual allocation of risk as reflected in intercompany agreements needs to match the stated transfer pricing policies, because clearly if it doesn't, then there's a potential problem. Number two, intercompany agreements need to be contemporaneous. In other words, they need to be put in place at or before the commencement of the relevant transactions, and we'll come on to some practicalities of that. Number three, defective intercompany agreements, which could mean wrong agreements or missing agreements, are an obvious point of focus for tax authorities because it's such an easy target. And the final point is that the longer that issues are left unfixed in terms of the robustness of legal implementation of transfer pricing, the greater the exposure. And that's just a function of the fact that you can't rewrite the past. You can fix issues going forwards, but in terms of the historic non-compliance, that's something that just needs to be dealt with, and on a damage limitation basis, it cannot be retrospectively fixed. So let's move on and talk about a timeline in practice. And again, this diagram is really stating the obvious, but it just, we found it's helpful in highlighting some points that are often missed. So here we're looking at a series of transactions from the perspective mainly of the distributor. And we're talking about one particular financial year in which the controlled transactions take place. So that's year one on this diagram. So during that year, there will be a number of shipments made perhaps from the entrepreneur to the distributor. And those shipments are made and invoiced in real time, and they're subject to compliance requirements such as customs declarations in real time. And the price is what it is during those periods of the shipments. Following the end of that year one, there may well be a true-up adjustment, and this is to give effect to the guaranteed or minimum return of the distributor. So there may be a payment in either direction, and generally speaking, that would be made at some point during year two. So these are the intercompany charges, or some of the intercompany charges between the related entities. In terms of the tax compliance transfer pricing documentation, so the specific timing will obviously depend on the applicable regulations in the relevant country of the distributor, but probably at some point in the second half of year 2, the distributor will be required to make its corporation tax filings, and with that will be filing the relevant transfer pricing documentation to support it. In other words, the master file and relevant local file. And that will need to describe the relevant transaction, including the contractual risk allocation. And clearly, after that, after those filings, in years 3, 4, 5, and so on, there will be a window for tax and transfer pricing inquiries and the possibility of transfer pricing adjustments being imposed or negotiated or whatever. And as ever, there's the inherent unfairness that the tax inspectors always get the benefit of hindsight in terms of these arrangements, whereas from the corporate's perspective, the arrangements need to be put in place in advance. And that's shown by the red arrow at the bottom left of this diagram. In other words, for a local file and master file to be true in describing a particular entity as being in the nature of a limited risk distributor, because certain risks have been assumed contractually by the entrepreneur, that situation needs to be reflected in fact, in legal fact, meaning that the intercompany agreements need to be in place at or prior to the start of the year. So this is just describing, hopefully in a useful way, how the timeline of these things works in practice. So if we move on and talk about, well, okay, so what about our actual agreements? And here we're talking about a template distribution agreement or sale of goods agreement. It's not so critical what the title of the agreement is. And we're trying to design these agreements so that they match the transfer pricing analysis or the intended transfer pricing analysis in terms of matters such as inventory risk, product liability risk, and so on. So in terms of inventory risk, this can be addressed in 2 ways from the perspective of de-risking the distributor. Either the reality is that the distributor doesn't carry any stock at all, so maybe it acquires flash title with the actual shipments being made directly by the entrepreneur or the manufacturer or some other entity. And of course, we need to make sure that the agreements reflect that, don't contradict that. Or if the distributors do carry inventory, then we can de-risk them by, for example, giving the distributor the right, the option to require that the entrepreneur repurchases stock at cost, so as to move back to the entrepreneur the risk of the stock being unsold at any given point. Similarly, in terms of product liability risk, related regulatory risks, that would be usually documented by way of appropriate warranties or absence of warranties on the part of the distributor, plus an indemnity given by the entrepreneur against those, and obviously being careful to make sure that any caps on claims within the boilerplate of the agreement don't operate inappropriately. We'll come on separately to guaranteed return because that's a function of the pricing clauses. But similarly, in terms of credit risk, we'd be building that into the intercompany agreements templates by, for example, an obligation on the entrepreneur to purchase book debts at cost at the request of the distributor. That would be one way of de-risking from a credit risk perspective. And finally, foreign exchange risk, well, obviously that's primarily a function of differentials in currencies affecting the distributor. And so we've been looking at the currency for payments of the purchase price to the entrepreneur under these arrangements. So just going into a little more detail on the pricing clauses in the intercompany distribution agreement. And very often we see what I've referred to on the left-hand side as an agreement to agree approach, as opposed to the approach that we would recommend. So in terms of the agreement to agree approach, possible forms are no agreement at all existing, so the arrangement is not documented at all contractually, or an agreement which leaves the pricing open, so it just says the parties will agree that the pricing of goods on an order-by-order basis, or an agreement that just has a vague reference to transfer pricing policies or the arm's length principle, which is probably going to be too vague to provide legal certainty in these arrangements. And all of those approaches have or are likely to have the same impact, which is there's no guaranteed return because there's no legally enforceable pricing clause there. There may be no binding agreement at all, and this is on the basis that clearly price is one of the key elements for any agreement for the sale of goods. And if there's no legal certainty as to price, there may be no legally binding agreement at all, which means that you've missed out the opportunity to have a contractual allocation of risk in relation to those other factors like inventory risk and product liability. Meaning that your transfer pricing policy has not been legally implemented, and any historic tax filings which represented a de-risked position may need to be corrected because they're simply wrong. So that's what we wouldn't suggest. In terms of what we would suggest, it's an intercompany agreement which clearly expresses the target return or the minimum return in a legally enforceable way. So usually based on a formula to calculate operating margin or the relevant formula there. But the agreement also needs to reflect the reality, which is that the pricing of individual shipments or deliveries will be adjusted throughout the year by reference to forecasted figures, but with the intention of achieving that minimum or that target return, plus a legally binding provision for a contractual true-up mechanism after the year end. So that's the approach that we would recommend. In terms of actually operating that, generally speaking, groups will want to try and minimize the reliance on that true-up mechanism because it can create issues as regards customs compliance and other knock-on effects. So just to wrap up, we've talked about what a limited risk distributor is, and by the way, although we've talked primarily about the sale of goods, the same principles apply to distribution of software and resale of services like testing services or maintenance services and so on. We've talked about what is the nature of a limited risk distributor, so it's not a term of art, but generally speaking, the kind of statements that you see in transfer pricing documentation relate to absence of inventory risk, product liability risk, plus a guaranteed return. And we talked about the timing of agreements in terms of making those kind of statements a reality and the fact that they need to be in place prior to the relevant transactions taking place. So just to finally wrap up with some action points, and presumably you're not just watching this because you couldn't find anything better on Netflix, and presumably you've got some live issues that potentially need to be looked at. And so really one of two situations are going to apply. Either you've got written intercompany agreements in place or you don't. If you do have written intercompany agreements, then the action point is, number one, get them checked. So check them to see whether or not they are consistent with the statements in your current transfer pricing policies. And we've included on this slide an example of what we call a traffic lights report, which is doing exactly that. And I have to say that on every for every multinational group that we've helped so far, when we've reviewed their existing sample agreements, we found that there are serious issues that do need to be addressed. So it's important to be aware of that. Number two, fix your intercompany agreements if needed, and obviously we can help with that too. As you know, we can fix them going forward, but we can't rewrite the past. Number three is that you'll need to review your historic transfer pricing and tax filings, because it may be that your previous filings have represented a situation as regards allocation of risk, which is just not true. And that will need to be looked at as to what knock-on effects it does have as regards the actual transfer pricing analysis which should apply. On the other hand, if you don't have written intercompany agreements, then action number one is fix the gaps for ongoing periods, so that put in place appropriate intercompany agreements. And number two, again, you'll need to review your historic transfer pricing and tax filings to see whether voluntary disclosure of non-compliance needs to be made. If you do need help or you'd like to arrange a consultation with us, then please feel free to get in touch. I've included on the slide there our contact details in terms of telephone and email. And if you have any other questions or comments, please do reach out. We'll be very happy to hear from you. Thank you very much.